Welcome, and we're excited to have you this morning for our tax credit webinar for contractors and what you need to know with everything that's happened and what's kind of going to go on for 2021. We're excited to partner with Barnes Dennig this morning, and just a couple housekeeping things before we get started. If you are not muted, please stay muted as we go through the presentation, just so there aren't any interruptions. As for questions go, feel free to enter those into the chat and we can address them at the end. Or I think that after each of their respective sections that Scott and Andy will be asking for questions. So if you have some at that time, feel free to unmute and ask away. We're here for you and we want all of your questions to be answered. And I'm Jen Galt with ACI, by the way. I'm the Education Program Manager and I have the pleasure of working with Andy and Scott to make this webinar happen. So Scott Cress is one of the speakers today, and he is one of the leaders of the COVID-19 Advisory Services team with Barnes Dennig, providing strategy and insight that helps clients navigate the best path forward. He also helps lead the firm's transaction-based engagements, which include valuation services, M&A engagements, and succession planning, to name a few. He has over 22 years of experience, both in and out of public accounting, and receives advanced training to help middle market clients traverse an ever-changing business environment to make informed decisions that align with their long-term strategy. And our other speaker this morning is Andy Bertke, and he's one of the leaders of the COVID-19 Advisory Services team as well. And he helps provide strategy and insight that helps clients navigate the best path forward. With more than 30 years experience in public accounting, he leads the tax consulting practice at the firm and uses his business and analytical skills combined with tax knowledge to provide clients with sound tax planning ideas. And as a member of the AICPA's tax section, he keeps a laser eye focus on the ever-changing federal, state, and local tax laws. So with that, I will turn it over to Scott and he will kick off our presentation for this morning.
Great, thanks, Jen. So we'll share the slides afterwards. We don't need to go through a lot of the history of Barnes Dennig. You want to go to the next slide? Let's see. Yeah, we do have one thing I do want to tout is, these things are complex. And as we're getting ready to talk about, I mean, this is probably our 5th major stimulus package that just got rolled out, and things are forever changing. They're forever fluid. So be patient with your advisors, but we have a team of people that kind of just stay behind the scenes and really dig into the weeds. So when we get to that level of questions, feel free to reach out and we'll make sure we get you in touch with the right person. All right, Jen, you go to the next slide. All right. So, today, this webinar is really going to focus on a couple of payroll tax credits that have really been around since the start of the pandemic. Now, these programs were expanded and even tweaked with the Consolidated Appropriations Act. And again, really most recently with the American Rescue Plan Act of 2021. So for those keeping score, the latest ARPA bill was the 5th major COVID-related stimulus package that was been rolled out to date, and really with a cumulative cost of nearly $4 trillion. So, arguably the tax credits we are covering today really weren't on the radars for most employers. In the case of the Families First COVID Relief Act credits, we suspect many companies just fully didn't understand how it worked. In the case of the employee retention credit that Andy's going to touch about here in a few minutes, really that wasn't available if you received a PPP loan. So, that immediately wiped out 90+% of our client base, from the get-go. So the good news is the latest bills made taxpayer-friendly updates to the rules. They allow even retroactive look back in some cases to determine if they apply. So, the message is don't feel like you've missed the boat. You can always go back and file amended payroll tax returns and take advantage of these programs. And really, in some cases, you can even get an advance on the expected credits going forward. All right, next slide, Jen. Today's agenda. So I'm going to kick things off and discuss the Ffcra credits really on a high level. Those are comprised of two different calculations. The first being the Emergency Paid Sick Leave Act, which is calculated over a 2-week period. And the second being the Emergency Family and Medical Leave Expansion Act, which is calculated over a 2 and then another really 10-week period. So eligible employees can qualify for both of these programs. From there, I'm going to hand it over to Andy, and he's going to discuss the employee retention credit and how to maximize that program. That one is a little bit more complicated, so we'll save a little bit more time for it. But, understanding we're going to hit these on a high level. So really, we just encourage you to discuss the details with your advisors and make sure you maximize the total benefits. We'll discuss how all these wage-based benefits, whether it's these two credits, PPP forgiveness, the research and development credits, really how they're all intertwined. And the message needs to be really that you got to do some digging to figure out how to maximize the benefits from all these stimulus packages. So from there, we'll take some questions at the end, and always free to contact either any of us afterwards. All right, Jen, next slide. All right, so as I mentioned, the Ffcra payroll tax credits are really made up of two separate calculations. And so for those employers with 500 or less employees, and that's measured on April 1st of 2020, paid leave was really not voluntary. You could have an out if you had 50 or fewer employees in some cases, but you have to keep in mind these programs were really meant to protect the employee. Now going forward, as of January 1st this year, paying sick and family leave is voluntary. So, it's a little bit of water under the bridge at this point. But I will admit, when this first rolled out last spring, we had a little bit of heartburn internally. We could see how this potentially work itself through the grapevine, so to speak, and lend itself to abuse. Fortunately, a year later, after talking with many of my clients, I really don't think that was the case. But, now originally the Ffcra credits expired on December 31st, but the latest bill expanded the program. Now this runs all the way through September 30th of this year. So really the effective date for the Ffcra credits is measured from April 1st of 2020 through September 30th of 2021. All right, Jen, next slide. All right, so again, two separate calculations for the Emergency Paid Sick Leave Act. Now, keep in mind, in all cases, qualifying wages are those paid to employees who could not work. So if your employees did work from home, even on a part-time basis, the wages paid for that day will not qualify. So clearly the ability to work from home is greatly impacted by your industry. Our firm had its fair share of COVID-related absences, but in our line of work, you can easily work from home as long as your symptoms allowed it. So, obviously there are certain industries, construction being one, where you can see this potentially being much more impactful. So the first part of the calculation, and really the one with the greatest potential for benefit, is related to when the employee themselves could not work due to COVID-related reasons. So if the employee themselves contracted COVID and were forced to quarantine, or if they were advised by a healthcare provider to quarantine because they were in close contact with someone who had it. And really there's a catch-all really. If an employee was experiencing symptoms and seeking medical diagnosis and cannot work, but you continue to pay them, then the credit is calculated with a cap of $511 per day for up to a maximum of 10 days. So, $5,110 per employee. Now at that cap level, an employee would have to be paid, close to north of $60 an hour in a typical 8-hour day. So if your employee is paid less, you would still get reimbursed at the 100% of the employee wages and just not reach the cap. Also keep in mind that you can bolt on the cost of healthcare benefits on top of the actual salary that's being paid. All right, Jen, next slide. The second calculation revolves around an employee missing work due to having to care for someone who is subject to a quarantine, or to care for a child whose school or child care services closed due to COVID-related reasons. So in this situation, the employee themselves may not be sick, but they have to care for others. So, I will say we as a firm probably have seen more instances of this than anything else. I don't know how many of you have small children. I do. And thankfully they're back in school full time, but I can certainly attest to the challenges of having to juggle school, with two working parents. So in these situations, the calculation of the credit is a little different. Here in the past, you had to pay at least 2/3 of the employee's normal salary, and the credit was capped at $200 a day or $2,000 in total. So again, if the employee is out because they are personally experiencing COVID-related symptoms, the credit is capped at $511 per day over a 2-week period. But if the employee is not working due to having to take care of others, the credit is capped at $200 per day over a 2-week period. All right, Jen, next slide. So that, we just covered how they work over the first 2 weeks of pay. But for those employees that need to continue time off due to caring for a child whose school or childcare is closed, qualifying wages include up to 10 weeks of pay at the same $200 per day cap, which could allow for a credit of up to $10,000 per employee. Now, keep in mind, these days do not have to be used concurrently. So we have situations in our office over the last several months where employees can't come into the office during specific days of the week due to having to care for a child. So maybe they've arranged a schedule with their working spouse, and Thursdays are their day to stay home with the kids. So in that situation, if they cannot work and you continue to pay them, those wages are eligible for a credit. Again, capped out at $200 a day. So, hopefully we see a little less of this now going forward, that most schools and daycares, are back in service full time. All right, Jen, next slide. So again, a quick recap on the Ffcra credits. Keep in mind, this was mandatory with less than 500 employees last year. There were some outs for some small employers with less than 50 employees. But going forward, paying employees for sick or family leave due to COVID-related reasons is voluntary. Currently, wages paid through September 30th of this year are eligible. You can have the benefit of hindsight and file amended payroll tax returns to claim the credit. So again, understanding this wasn't front and center on everybody's radar at the time, you can now look backwards to determine if you're eligible. These are refundable payroll-based credits, so you'll need to work with your payroll providers to claim them. Wages used for PPP loan forgiveness will not qualify for Ffcra credits. So basically, you just can't double dip, and that's where the art comes in. You really have to determine how to maximize the PPP loan forgiveness, the Ffcra credits, the employee retention credit, maybe an R&D credit, because they're all really intertwined. So, we really do encourage you to take a deep dive with your advisors and figure out how to maximize these programs. That's why, it does get confusing, and that's why we almost have to have a dedicated team of people where this is really largely all they do. So that kind of wraps up my Ffcra discussion. And before I turn it over to Andy to walk through the ERC, Jen, maybe I'll pause. Do we have any questions come in?
I don't see any. If
right.
anybody has a question and you'd like to unmute real quick and ask, please do so.
And we can always, take questions at the end, shoot us an email, one-on-one, whatever you're comfortable with.
Have you all heard anything about symptoms or side effects from the COVID vaccine being allowable in this new round?
Well, that's an interesting question. I have not directly, Andy, I don't know if you have, but to me, I think the language of these bills are so broad that you can connect dots relatively easy. So a lot of times are seeking, seeking care for COVID symptoms in general, right, is qualifying enough. So I wouldn't be shocked if someone and I have heard of people, whether it be the first or second shot, right, who put them down a day or two. Mm-hmm. And so again, I haven't heard direct language to the contrary, but my belief would be that would also be a qualifying paid sick leave day.
Okay, thank you. And then
Yeah,
I also read, I think, where the amount of time that an employee can take resets on April 1st. Forgive me if you just said that, but that if they took it, like, let's say between March of last year and March 31st of 2021, that allowability resets April 1st.
yeah, right. So you've got a 2-week period and then a 10-week period falling in 2 different calendar years and extending beyond 12 months. So, right, this program first kicked off on April 1st of 2020. So largely it would make sense that those 2 and 10-week measuring periods, would start and sunset between April 1 and March 31st of 21, and then potentially restart again going forward
Okay, great.
between
Thank
April
you.
1st and September 30th at this point.
Thanks so much.
Mhm. Well, again, if we have any more questions at the end, no problem. And you can always reach us for an email. So, Andy, I'll kind of turn it over to you now.
Sure. Jen, the next slide, please. And Jen, thank you for hosting this, and thanks for everybody out there taking the time out of your day to, listen to us talk about credits. Sounds boring, but they are very, very powerful credits. They become a pretty large number very quickly. And again, I know you're all busy out there with work and NCAA brackets, but if your brackets are anything like mine, you don't have anything else to watch. So moving right along, when we look at this credit, the employee retention tax credit, it's 4 easy steps, right? Well, we all know nothing's easy, but we go through, we determine whether or not the company's eligible. Then we determine if the employer paid qualified wages. We calculate the credit, and then we claim the credit. So going on to step 1 on the next slide. So there's, who is an eligible employer? There's 2 ways to get to be an eligible employer. One, you could have been partially or fully suspended by a government order during any calendar quarter in 2020. Now, this is just the 2020 ERTC. We're going to talk about 2021, not in a lot of detail because it's a lot of the same stuff. It's just that some of the parameters have changed. So again, fully or partially suspended by a government order. Now, I know a lot of contractors were not, they were essential, so they were not necessarily suspended or have their operations suspended. The other test, and so it's an either or. So if your 2020 gross receipts are less than 50% of your gross receipts compared to the same calendar quarter in 2019. So you look at a quarter in 2020, you compare it to 2019. If it's less than 50%, then you qualify for that quarter. The other items that you have to consider is, just as Scott said, you can't double dip with the Ffcra, you can't double dip with other payroll tax credits, such as the R&D and the WOTC, which is the work opportunity tax credits. You also cannot double dip with wages that you use for forgiveness on your PPP loan. So, as Scott also said earlier, it's a real art to put together a worksheet that takes into consideration of all these other programs that we have to consider when we're going for the the employee retention credit. I don't think I want to make a point on anything else on this slide. So next slide. So I said before that essential businesses, a little more difficult for them to be partially suspended, but it can happen. I've seen in cases where suppliers can't deliver critical supplies and materials. You're sitting there on your job site, you might not be able to have a piece of equipment. If that supplier was suspended by an operation, operations were suspended by a government order, that affects you too. Okay, so that you have to be cognizant of that. And a lot of contractors own multiple businesses. So what the credit does is it looks at all companies that the employer owns and controls. So, the example that Scott and I like to toss around is, the construction contractor is contracting or her contracting business, and they also own a restaurant. Well, we all know the restaurants got destroyed. Well, guess what? Because that restaurant was suspended, so was the construction company. So again, they're looking at this as a single employer. It's very powerful, and it's very, as Scott said, connect the dots, saying, it's very broad. The other item that a essential business can be affected is, you might have a job here in Cincinnati and you might have one in New York. Well, New York is a whole different animal than it was here in Cincinnati with shutdowns and that. So that's another potential situation where the contractor's job in New York was affected, not here in Cincinnati, but it doesn't matter. Since New York was affected, so was Cincinnati. When you look at, again, the global single employer concept. Next slide, please. And then the next step is did the employer pay qualified wages? Now, a big difference there is under 2020, again, we're still in 2020, it mattered if you had 100 or fewer employees, or if you had more than 100. If you had 100 or fewer, if you were affected by a government order or your sales were down, wages paid to every employee would come in play for the credit. But if you had more than 100 employees, it was only the wages paid to those employees who you paid basically to sit on their hands. In other words, they didn't work. They didn't remotely work. They didn't do anything. You just continued to pay them. Next slide, please. And then step 3, the easy part, right? Once we figured out if you're an eligible employer, once we figured out if you had eligible wages, then we just do the math. And the math is pretty straightforward. For 2020, the credit is 50% of up to $10,000 in qualifying wages. So let's say you qualify for 2 or 3 quarters, everybody is making 40,000 or whatever more a year. You're going to cap that at $10,000 for wages paid in 2020, multiply it by 50%, and your credit is determined max of $5,000. So, you can do the math in your head quite simply. Even if you just had 10 employees at $5,000, that's a $50,000 credit that's sitting out there. And then there's some little nuances again with the time frame. Again, it zeroes in on whether or not you have 100 or fewer employees or more than 100. If you're affected, the biggest one being is that if you're affected in 1 quarter, and let's say it's only a portion of that quarter, you get the whole quarter of wages, not just the time when you were shut down or anything like that. You get the entire quarter. And then if you happen to have that 50% dip, which I hope you did not, but if you did, you go for this credit. You continue to qualify in each quarter until your revenue in 2020 is at least 80% of this revenue in the same quarter in 2019. So again, that quarters just keep rolling on. And then of course, when you hit the $10,000, it maxes out. So next slide, please. And in claiming the credit, what happens is your provider, your CPA, your in-house CFO calculates what the amount of the wages are, calculates the credit, and will give some deliverable to the payroll company, or if you do it in-house, you'll basically go back for each quarter that the credit will apply and amend those 941s, i.e. a 941X, back in 2020. So again, if your outside CPA is doing that, they should give you a deliverable that shows the wages, shows the credit. They'll work with your payroll provider to get the 941X and get that refundable credit. Again, a refundable credit is very powerful because that means you get money even though you didn't pay the tax. So next slide, please. All right, 2021 has a few little nuances, and some of the bigger ones are you have the 50% decline in gross receipts in 2020. Well, that's a 20% decline in 2021. I used a $10,000 example in 2020 because that's the limit for the full year, $10,000 of wages times the 50% to get $5,000 in 2020. In 2021, it's 70% of that 10,000, and that 10,000 reloads every quarter. So you're looking at a $28,000 credit as opposed to a $5,000 credit back in 2020. Again, extremely powerful. And of course, the fully or partially suspended operations do apply as well in 2021. Let me see if there's anything else I want to make a point on. The other item is we had the 100 employee threshold, remember, back in 2020 that I spoke about. For 2021, it's up to 500. And I used the term employee, but the actual calculation is done on a full-time equivalent, okay? And a full-time equivalent is based on a 30-hour work week or 130-hour month. So normally we think of people working 40 hours a week, but for these credits, we're calculating full-time equivalents on a 30-hour work week. That really came from the ACA, Affordable Care Act, where we had the health insurance that came on board years ago. And I think Congress in their infinite wisdom said that, you know what, if we leave it at 40 hours, employers are just going to cut everybody back to 35 and they won't have to cover their employees for health insurance. That's why the 30 hours is even in the code. Again, with 2021, no double dipping, with Ffcra, WOTC, work opportunity tax credits, R&D, contractors can have R&D costs. Hopefully you guys are taking advantage of that. That's another credit. Hopefully you guys are taking advantage of that. And again, the PPP loan, the money used to pay wages with the PPP funds cannot be used for the ERTC credit. Now, that sounds onerous, but when you think about it and you kind of look back at what you had done in 2020, if you got the PPP loan, we're finding a lot of people had borrowed, maybe they borrowed 500,000 or maybe they borrowed 50,000, but their wages in that same period were 2 times, even sometimes 3 times that amount. So it's not as tight as you might think. Next slide, please. Again, here's what I was talking about, the 500 or fewer employees, where you get to use the wages for all the employees for the ERC credit. Whereas if it's more than 500, which was 100 for 2020, it's only paying for folks to sit on their hands. So next slide, please. Again, the same scenario in 2021 as there was in 2020. Get the qualified wages, multiply it by 70% to get your credit amount. But remember, this reloads every quarter for 2021. And the next slide. Claiming the credit. So we're in 2021, right? We're getting ready to file our first quarter 941s. You can get an advance credit of up to 70%. In other words, you can start applying that. You can make this calculation, give it to your payroll provider, and they can start applying that advance credit to taxes that you would otherwise be paying with that 941. A little nuance between again, with the 500 or less than 500 employee count. In the next slide. So there's a couple of other things touch on quickly. At the bottom of my heart, I hope none of you are there, but the recovery startup business was new. We're still trying to fill in some of the gaps. We're waiting on guidance on that. That came out through the American Rescue Plan Act, which was just a couple of weeks ago. But it looks like for companies that started up after February 15th of 2020, meets certain gross receipts requirements. Again, we don't know what those are yet. Again, Congress does the laws, they send it over to the IRS interprets it and then gives us guidance on what Congress meant. The other part of that particular business is that they're going to get a maximum credit of $50,000 per quarter, even though they don't satisfy the gross receipts requirement or were subject to a full or partial suspension of their operations. Again, we're not sure what that looks like, but if you did start your business and you're like, well, I don't have anything to compare to, there's probably some hope for you in that recovery startup business. The other one, which I really hope that you're not in, is a severely financially distressed employer. And that's where you're off 90% in 2020 over a 2019 quarter. And, you know, the one thing I will point out, which was kind of unique when you're doing the gross receipts test, is that you don't have to prove, you know, gross receipts may have been 40% in 2020 versus what they were in 2019. I mean, you don't have to prove that that happened to do with COVID, okay? You just have to have the reduction in gross receipts. So whether that was a bad takeoff or what happened, you know, you don't have to prove it. The last point I'll make is to, you know, exercise caution. Normally our statute of limitations when we're looking at tax matters is 3 years. The IRS has decided to make extend the statute of limitations to 5 years on these particular credits. So they're going to be looking at these. So you want to get it right. You certainly don't want to get a $100,000 credit and then 5 years later find out you owe interest and penalties on that credit that you took in error. As you guys all know, the interest and penalties can make it very, very bad, very, very painful. The next slide. So this is a little spiel for Barnes Dennig. You know, we do PPP loan applications and loan forgiveness services. You know, one of the slides that Scott was talking about, we're somewhere north of about $75 million of loan forgiveness applications. And I'll probably jinx myself here, but so far we've had 100% forgiveness for all the ones that we've prepared. We've prepared ones that are over 2 million, which are highly scrutinized. So, you know, it takes a lot of knowledge. It sounds like it's easy, but it takes a lot of knowledge to get those right, get those through the process, especially when the SBA is asking questions. And the other items Scott talked about with the dedicated C19 advisory team. So I think we'll go on to the next slide and try to get to some questions. So yeah, we're all, you know, pun intended, we're all a bunch of lost puppies when this came out, but we you know, we can get through it. We can help you get through it. And, you know, so ask your question to fire away.
So we did have a couple from the chat. One says, what if a construction company was negatively impacted by social distancing requirements on job sites, supply chain interruptions, etc.?
Yeah, we get that question often, and it's difficult because you are still able to work. They use a lot of examples, and not a lot, I shouldn't say that, they didn't give us that much guidance, but they use a few examples where, you know, if you're still able to you know, handle your customers or get the job done, you weren't limited, like they didn't tell you can't work. It didn't matter whether people wouldn't come out of their home, you know, to buy your product. You know, it really had to be a government order to you know, to qualify. I think what they were thinking in that situation where, okay, yeah, you got to be socially distanced and all that stuff. Well, if it really did have a bad impact, that should show up in your gross receipts, right? In your sales. I think that was their mindset. Supply chain interruptions, again, if your supplier had to get critical parts, not something that you could source somewhere else, you know, relatively easily, but if they just shut down one of your supplier and they had to get the, an HVAC unit or something that you couldn't even move on to the next part of your job, then I think you may have something there.
The next question, we are a staffing company specializing in skilled trades. We took out a PPP loan for our admin team only, so none of the EEs that we contract out to our clients. Should we limit the ERTC to our admin team? Of course, not double dipping with PPP, or can we use the ERTC on all employees, staffed, contracted, and admin?
So what I have seen so far is that contracted employees still qualify, but I will have to verify that. So I will follow up. If you send me an email, which is on the last page with that question, I'll be more than happy to follow up with that.
And then let's see. Question regarding Ffcra payroll credits. Have Scott or Andy run into any problems amending previous 941 returns to take advantage of previous quarter's credits?
What we've seen, so as you see at the slide, you see the ERTC quick test at the bottom. If you click on that link, you'll get to a 10 or a 12 question test that we developed to give a, kind of an acid test, whether or not we think somebody would qualify. And then of course we roll up our sleeves and start digging in. But a lot of times that test would tell us pretty bright line that, okay, they qualify. One of the things that we found out in doing that test is that a lot of people were paying folks for a couple of weeks that, had symptoms or had care for a child, as Scott was talking about in the Ffcra, but they didn't know that existed. And Scott was on the forefront of this. He was out there in February of last year when this stuff's coming out, and he's trying to get through all this. And it's very difficult and very, mind numbing as far as, who would qualify and so forth. So it flew under a lot of people's radar. But what we're able to do is say, you know what, you probably didn't qualify for the ERTC, but when you were paying those wages back to people who were sitting at home watching, worried about themselves or worried about or watching their children regarding COVID, then you probably got an opportunity there to go back and get that credit.
Yeah, and to answer direct too, I mean, obviously it's a payroll return based credit. So I think the payroll processors probably have their thumb on the pulse of rejections, if you will, or what problems might exist. I can tell you, after discussing with a couple of people, be patient with them as well, right? So they're kind of figuring out how to go about applying for these credits too. And a lot of them just didn't have the resources or the back end functionality really to go back and do that yet. So we are seeing more going back and doing the amending now. I have not to date though, heard of one getting bounced or having issues going through.
Right. The other part that I'll add on to that is that, through the CARES Act on the income tax part, we amended a lot of returns for NOL carrybacks. The NOLs went away beginning in 2018, but then 12 months later, they come right back because of the CARES Act. And not only did they come back, they came back with a vengeance. We could carry back for 5 years. The point being is that we were carrying these back and we're getting refunds, but the refunds are taking time. So again, when you get your 941X in, it's probably not going to hit your bank account in 2 weeks. Some of these we've seen take up to 6 months.
Yeah, anything paper filed right now is clearly extremely slow.
Okay, I think those are the only questions I see in the chat. If anybody has any additional questions, feel free to unmute and ask. All right. Otherwise, you guys are all done, right? We're good?
Yeah, if they don't have any questions or want any, enlightening on any particular slide, certainly can get a hold of me by my email and by Scott. So
Great. Well, thank you guys so much for this presentation. I know it was helpful. We got some thank yous coming in the chat right now. Again, this is recorded, so we will be sending this to you later in the week, hopefully within a few days, with the slides as well, and a short little survey if you wouldn't mind taking that for us. But other than that, that's all we have for today. And thank you, and we hope to see you next time.
Thanks, everyone.
Thanks.